And for more on the GDP, let's unpack those numbers with our next guest, Jimmy Jean, chief economist and strategist at Desjardins. Jimmy, thanks as always for joining us.
Good to be here.
Were the numbers where you expected?
The numbers obviously came in much above expectations. However, looking into the details, we find lots of surprises. You see, and it's actually the mirror opposite of what we saw in the second quarter. In the second quarter, the weakness was largely due to net trade, so the collapse we saw in exports. Now, in this time, we see that upward surprise, but it's due to, again, that net trade component, and particularly, it's not a story about exports recovering. It's really about imports collapsing. And that mechanically produces that strong increase in GDP. But when you look at domestic demand, which had been the very positive story in Q2, we're seeing a decline of 0.1%, and you're seeing cutbacks in consumer spending in particular. So I think that's cause for concern here.
Okay, Gavin, we'll let you jump in here.
So although we've officially avoided a recession in the sense of 2 negative quarters, as you said, from the details, it looks as though firstly, it's largely mechanical because of the trade balance improving, not because of exports growing, but imports collapsing. And secondly, that seems to be reflected in lower domestic demand. That's not a particularly optimistic outlook, is it?
It's I'm concerned about what we saw. Particularly knowing the dynamics we're seeing in the labor market. We had an indicator yesterday coming from the survey of employment payrolls and hours, and earnings payrolls and hours. And what this told us was that in September we saw 58,000 decline in employment, and that was completely opposite to the signal we earlier had from the other survey, the labor force survey. In this survey, we tend to put more weight on that one particular survey that came out yesterday because it's actually a census of businesses as opposed to just being a survey of households. So this is something that's very important. The second thing I think that we should be looking at very closely is what happened in the flash estimates for monthly GDP numbers. So we received that as well today, and what we learned is that in October GDP seems to have contracted 0.3%. So there's a lot of choppiness in the numbers, but a 0.3% negative at the onset of a quarter really suggests that quarter will probably see weak growth. The Bank of Canada was hoping for 1%, but we've been tracking below that, and that tracking might be reduced further.
And I just want to jump in on a couple of things here. The investment in residential structures was up by 6.7%. Also, government investment expenditures, another major contributor. Where did those two numbers come from? Let's start with the residential structures. An increase like that.
Well, I think what we've seen this year, and that's actually one of the good stories that has been sustained in this report, is that we've seen stronger construction, residential construction, and that's been boosted by various federal policies, but also provincial policies that have been put in place over recent quarters. So we're seeing the effect of that. We're seeing the effect of as well monetary policy accommodation. Residential, the real estate market tends to be the first one to respond to that. And in addition, we've seen strong sales. Sales have recovered in Ontario, and we've seen also strength in Quebec on that front. And that will be captured in those GDP numbers when sales activity, when the number of transactions improves. So I think it's a reflection of that. So it means not all hope is lost when it comes to domestic demand, but you are definitely seeing households being more prudent. You see that in how the saving rate increased, and as well as that contraction in consumption spending. So I think it's not the residential part is not something we can take for granted either. You have some pockets of the market that are oversupplied. You have that deceleration in population growth that is going to hurt demand in that space. So, to your point about the government, I think much of growth in 2026 will rely on government spending and progressively government investment.
Not always a good thing. We'll leave last question to you, Gavin.
So would it be fair then to think that perhaps the Bank of Canada, looking at these rather weaker numbers, might decide to cut again when they meet in early December, especially as it looks likely that the Fed is now leaning towards cutting interest rates as well?
I think for now they will be on hold, but still, I think they will take note of that information in the sense that the domestic demand came in weaker, and also that new information coming out of the labor market. They've signaled in the past that the labor market would be a key factor they'd be looking into. I think at this point they just want to get more data, more confirmation. Like I said, there's in some sense there's a lot of choppiness. So they want to have a clearer signal. So, if I have to guess for December, I think they're still on the sidelines. But they've been clear as well that if the numbers, if their tracking was to be disappointed, if the numbers were to surprise to the downside, they'd be ready to move again. So that's certainly still an open possibility for 2026, I would say.
Okay, we're going to have to wrap it up there. Jimmy, thanks as always for joining us.
Pleasure. Thank you.
Jimmy Jean is chief economist and strategist at Desjardins.